Hey everybody, I wanted to talk about gold. It's been very popular lately, I'll say, and it can be used as a nice diversification in a portfolio. So let's take a look at this. First of all, a lot of people seem very surprised at the earnings in gold. That just simply the price, the spot price of gold. You can see, and I can obviously go back even 1,000 years on this, but let's just talk about more modern history. 2007 through 2023, 30%, 5%, 24, 29, 10. Has it taken a dip? Yeah. 2013, 14, and 15, it struggled, but then bounced right back, had a couple of little sideways years. But boy, those up years are pretty significant. I did 2000 to today, and we were at about 6% annual compound rate of return on just the price of gold from 2000 to today. So that's kind of surprising for a lot of people. And depending on what you're matching it up with, it might even match or compare very well to the S&P 500, which again, so many people seem very surprised about that. But what I think is very interesting is the lack of correlation to the stock market. The reason we use bonds and other stable, safer investments is because of their lack of correlation to the stock market. So when the stock market goes down, the other stuff in your portfolio shouldn't be hurting as much. So we'll take a look at that in a second. But let's also just touch on all the different ways that you can buy gold, that you can add it to your investment plan. So starting with things like bullion. Okay. Now, out of all these choices that I can talk about here, the reality is bullion is what most people that buy significant amounts do. They actually buy the physical bullion, but then you start running into costs to store. You run in, or you store it at home, and then you're filling walls and whatever with that. But there are plenty of people that own significant amount of gold, and they're usually going to do that with the bullion. Now, if you're going to buy smaller amounts, gold eagles, they're more expensive to buy and sell. You've got that cost. I've seen anywhere from say 3% to 5% markup on buying, and sometimes it can be even worse when you go to sell it. But the cool thing about the eagles, the gold and silver eagles, is that the United States considers them currency. So when the price of gold goes up and you sell the gold eagle, there is no taxation on that. Whereas everything else, there is supposed to be taxation. I say supposed to be. The IRS has not forced the coin shops and all that kind of stuff to report the gains. It is up to you to report your own gains. So something to keep in mind. Bullion, you are supposed to pay taxes on those gains. Gold eagles, you are not supposed to. You don't need to. Then there's what we call paper gold. Okay, so paper gold is the investing world type gold, buying GLD, that's a ticker you can buy that follows the price of gold, but you're going to have the price of gold minus the fee for that investment vehicle. You don't actually own the physical gold. Now, there are trusts out there that you can invest in just like GLD, where they will actually ship you the gold if you ask to. But for the most part, you don't take possession of it. You don't own it. You're just investing in it as a part of your portfolio to get this growth, this pricing growth here. Then there's some alternative ways like mining stocks. A lot of people believe in mining stocks, but boy, if I showed you the history and the profitability on mining stocks, you would run for the hills. It is not pretty. They don't pay big dividends, and the stocks don't seem to do very well. Certainly when the price of gold rockets, they will do better, but the reality is they do not perform as well as owning the stock, or at least they haven't. Obviously, past does not predict the future. Then there's the private investment world. So believe it or not, you can actually lease gold and you can lend gold. Gold is being lent out there and turned into bonds, and people are investing in them. You have to be a accredited investor to be able to do these types of things because they are private investments. But there is a legitimate lending world out there going on for these big mining companies that want to borrow in silver and gold because that's what they're extracting from the ground. So they borrow the money in silver and gold. So if the price of silver plummets, what they owe plummets, and it works out really well for them. And then there's really large jewelry shops, things like that. They are leasing the gold essentially. It's very, very similar to, say, a car dealership. You got millions of dollars in cars on those lots. They didn't pay cash for those. They're borrowed money to buy all those cars and pay back that loan as they sell the cars. And it really is run as a lease program from the car makers. And so these huge jewelry companies that are national or even global, I mean, most of this goes on outside the United States because gold is way more popular outside the United States. And the inventory in some of these jewelry shops is insane, multi-million-dollar pieces of gold. It's crazy what we're seeing out there. So we're seeing a lot of lending and leasing going on out there. And if you are an accredited investor, you can actually invest in a much better way in physical gold. So let's take a look at some of this. When we talk about standard portfolios, the reality is the vast majority of people have their money in stocks and bonds. That's pretty much it. It's a shame. It's just the biases that are out there at this point. But the reality is we've invested in bonds because they don't have the correlation to stocks. Now, if you look at this chart, you would say, why would I invest in bonds? They've done nothing. Well, that's because interest rates have floundered at near nothing for 20 years. That's just the reality of it. And if the investors out there really understood bonds, the reality is they know there's better alternatives out there, and we don't really see a huge value in it until miraculously we find a way back up to 10% interest rates, and then we're going to spend 40 years going back down. And I don't know that that'll actually happen or ever happen. We've had a little boost in interest rates, and that's why you see the losses in 2022 that you have not made up, and you are currently hurting again because of interest rates have jumped again. So now let's add gold into this. So the easiest way to invest in gold is either buy physical gold or invest in GLD. Now, it's pretty easy for me to go and pull up the spot price of gold each year, and that's what I've done. And then GLD, just using the posted history of the pricing of GLD, because there's no yield, there's nothing to that. So you'll notice that GLD just lacks, it falls a little behind the price of gold. And that's just because it has a fee structure in it. So you're losing value to the fee. The problem with the price of gold is the cost to buy and sell. So if you bought gold way back in 2006, you paid a tiny bit of a cost, but if you try to sell it, you're going to have to pay cost again. So if you're going to hold for a long period of time, then owning physical gold is much better than GLD. If you're going to buy and sell, well, then GLD is the best way to go. But notice this, look at this. Well, certainly the past performance of it has done way better than bonds. It just hasn't been as stable as bonds. There's that 2012, 13, 14, that kind of the doldrums here that they did lose money. But the reality is it's rocket launched right out of there. Gold is an asset that's somewhere in between that hard asset real estate bond world. Okay. Somewhere in between there and the stock market. Okay, so it becomes a very nice diversification. You got the 2008 and 9/11 and all that, and gold did well in those years, right? And then when the stock market was doing great, the gold market didn't do so well. And then the panic sell, every asset had a bit of a panic sell, but gold really kind of made its way through it pretty well. So the reality is yeah, there's some roller coaster, but it's not the same roller coaster as your stock portfolio. And then what's even crazier, again, accredited investors, you got to have more than $1 million investable dollars and a bunch of other qualifications, and you have to sign off on it. But if you can get into the private investing world and you're able to get the into the leasing and lending of gold, you can earn interest on this. And this just shows 4%, but the bonds out there are averaging over 7%. That's right, earning gold on gold. And that is just a fantastic opportunity. And the marketplace is begging for more money. There's more people that want to borrow in terms of gold than there are that want to invest in gold. It's just the reality of it. There's so many big companies out there that like borrowing money in gold terms, and so it's lots of appetite out there for it. But you put in that, you own the gold physically. You own the gold, especially if you're leasing. It's even insured, and then you're earning interest on it. You know, the price of gold plus 3% interest. That's the leasing, and that's little to no risk. That's pretty fantastic considering it's insured by Lloyd's of London. So interesting world out there in terms of gold. It is a fantastic opportunity and a great little diversification for a portfolio. So no problem making more videos on all of this stuff. I just wanted to talk about this as more of a diversification in just the standard portfolio. It's not a terrible idea to add this as an asset class to diversify the traditional stock and bond portfolio. Trust me, it way outperformed bonds the last 20 years. Significantly. Since 2000, it is averaged close to right around 6% annually. With some ups and downs, that's not bad. That's pretty much what the S&P 500 has done. And then if you're an accredited investor, you can actually earn gold on that gold, earn interest in the form of gold on that gold. They have a silver bond out there right now that's paying 13%. I mean, it's pretty fantastic. So obviously, risk involved in private investments, and most people that know me, I'm not a big fan of private investments. But when it's insured by Lloyd's of London, things like that, you start vetting this stuff and you start seeing the opportunities are certainly out there. So gold, not a bad diversification for the traditional portfolio. I am a fan of it. And if you're shocked that gold has done that well, look into it yourself. It really has. And it's something that has proved to be a great diversification for the average portfolio. All right. Happy to answer questions, talk about this. Gold is an interesting avenue. But I think certainly we have lots of ways to invest in gold at this point. And I think it is a valid diversification in a portfolio, especially when we're running the deficits that we are running and the amount of debt that we are running in the United States. Certainly a good idea. All right, yourinvestmentcounselor.com. If you can schedule an appointment with myself or any of our CPAs or my business partner as well. FPFEAZ.org is our nonprofit organization. That's where all our full form, hour-plus long classes. We teach those online and live every single month, every different topic every month. If you have not subscribed to this channel, we're putting new videos up every single week. So keep coming back, subscribe. That way you'll be in the know, and we will see you next week.